for many years, I went around and would start with something to the effect of financial services is not a Stanford problem. And as of today, I'm going to stop that for the following reasons. A, Stanford has now for many years, in many forms, been a thought leader in the work that I'm tangentially involved with and has spun out a number of students who we've invested in and many others who we've not, who I think are part of the impossible intersection that David is seeking. So grateful to be here. Let me share a little bit about my story. But I'm basically a venture capitalist, and I'm looking for market, if not better than market returns. And so I'm arguably in the business of making money off of poor people's backs. And I come to this unkind description of what we're doing by way of a financial institution that started in the late 60s called Sherpa. And so for those of you who don't know, Sherpa was kind of the granddaddy of economic development and invented greenlining and was the first and only bank, I think, to testify in favor of CRA and created the CDFI fund and a whole cottage industry of economic development in the United States as well as internationally. Many moons ago, someone introduced me to some of the founders of Sherpa, who I developed a crush on quite readily, which kind of opened my eyes to this whole world, really, that I think in one way or another that we're discussing. And I was so incredibly inspired by the kind of work that Sherpa did directly and the kind of work that they inspired. And at the same time, as I was kind of studying what they were doing, one of my ahas was that, after I came into their life about, 45 years into their journey, and they had created, a whole cottage industry that I just referenced. And after 45 years, this whole cottage industry is addressing about 0.5% of the population, which is clearly not even moving the dial from a national perspective in terms of the size of the need that is represented. So with a grant from the Ford Foundation, I joined a woman named Jennifer Tescher to start the Center for Financial Services Innovation, where we had a number of lessons that led to the work that we do today. One, I had no idea how many people are on the fringe of financial services. I think that's probably known to everyone here, but it was a big aha for me. And I was shocked, and still am, at the amount of money that low-income people spend on stuff that we all get for free and or get paid for, right? Like, I get miles for paying my bills. Someone else, spends $20 to have their bill expedited so that the electricity doesn't go out. Banking is not a panacea. I think kind of the going into this assumption was, we're going to bank the underbanked, and I've learned in many forms and ways that, I think a bank account as it is conceived today is not really what a lot of low-income people need. And I see that in both for-profit efforts and nonprofit efforts, including the bank-on efforts, which I think is a really enterprising, attempt to try and get people into banks. And I think in so many ways, often the bank is really just not the right solution. And financial literacy, as I think a lot of us conceive of it in traditional ways, really does not work. And there's still, even today, so much energy that goes into kind of old-fashioned, very well-intended forms of financial literacy. It's everyone's knee-jerk reaction that, we just need to, educate the unwashed masses and they will take care of themselves. I think there is absolutely a very powerful role for financial literacy, but I think it needs to be just in time in the form of a product. And many of us here have been working on these things for years and years, but it was a big aha for me. Another aha that I think is important to the work that we do is that the income divide does not equal the digital divide. And so, sure, not every low-income person is walking around with the iPhone X I have in my pocket, but nevertheless, and it's been true for quite a few years that access to the mobile phone and access to the internet is, while not perfect by any means, is really quite pervasive, even amongst relatively low-income people in the United States, and for that matter, globally. And a number of these insights and a collaboration with Walmart really kind of informed how we created Core, our venture fund. So back in the day, Walmart was looking to expand its financial services offerings, And who knew? But today, after a decade or more of work, every single teller at every single Walmart is a check casher. Walmart is the largest check casher in the country. Walmart's the lowest cost check casher in the country. And the square feet where Walmart offers financial services, check cashing, and a whole litany of other things are the most profitable square feet in Walmart, bar nothing. And so this kind of combination of things I found really exciting, and I think kind of philosophically is the basis of what we're trying to do, and it kind of touches on a number of your things, actually, of your points. So I spun out of CFSI in 2010 and created a small venture fund on the arguably naive pursuit that we could do your impossible intersection of making market returns and doing good for you financial services. So we're 10 years into that now, and we started investing in what you today call kind of FinTech for the underbanked. And I'll give you a couple examples of the deals that we've invested in. Some of you will be very familiar with them, but some of you won't. A company doing something that's terribly unsexy, but terribly everyday for people is a company called TO Networks. So we all pay our bills with our bank or with our credit cards. A shocking number of people walk into a convenience store with some cash and pay their bills that way. At the time when we first invested in this company, the average cost of an expedited bill pay, you can't wait for it to clear 3 to 5 days, you need it to clear now or the power will go out, is $20. So Western Union charges you $20 just to pay your bill. Then there's also the balance of the bill. And you have 5 bills, it adds up very quickly. So TO was doing this kind of thing at 1/10 the price, average $2 for an expedited bill pay. And again, this is not like an asset building kind of thing, but it's looking for a way that technology, new distribution channels, thin margin product can provide a really economically emancipatory product for a very everyday use. And TO grew to significant size, was clearing $14 billion worth of bills on an annual basis, and we sold it to PayPal a couple of years ago. Another company that was born and raised here on campus, formerly called Progresso Financiero, now called Opportune, publicly traded as of a couple of weeks ago. We first invested in it in 2007, then again in 2013. Many of you are familiar with this story, but I think it bears repeating for those of you who are not, because I think it's a really compelling and special opportunity. It was a mission-driven opportunity to provide credit to originally really to Hispanic customers, who were completely off the rails, completely ignored, had access only to the worst possible credit products available in the United States, with something that wasn't just 1/10 the price of a payday loan, but I think more importantly than the APR, was structured in a way that is kind of upwardly, enabling. So reports to the bureaus, tests for affordability, two things that kind of seem like innocuous matters, but are actually completely profound and important to someone getting out of a cycle of debt, someone getting access to lower cost capital, and someone entering into a loan that they are structurally more likely to be able to repay versus a payday loan, which either can't or won't look for affordability. And so, kind of as a matter of structure, is more likely to put people upside down. A third example is a newer investment of ours called Health Sherpa. And Health Sherpa is basically an Affordable Care Act marketplace for health insurance. After healthcare.gov, Health Sherpa has originated more exchange plans so they've originated more exchange plans but for healthcare.gov, that's what I meant to say, and have reached millions of customers and put them into affordable healthcare, and they're serving very much a low, moderate income customer. So we've made now 50 or so investments. These are a couple examples that really look at low income consumers, and we've learned a number of things over this journey. And a number of them, to me, are kind of annoying and humbling in that it took me a suspiciously long time to kind of figure them out and wrap my head around and kind of adjust our firm to place different kinds of bets. One is, also kind of to your point, David, a cheaper loan is good, but it's not really that great, right? Like at the end of the day, 10x better than a payday loan sounds cool, but like really what are you saving someone on a dollar for dollar basis? It's not that much. Really what someone needs much more is just more income and more steady income, to Josh's point where we were earlier today. So cheaper loans are good, but not particularly amazing. It's more than the young and underbanked who are financially struggling. I often cite, and I don't know if you saw the story, like in I think 2015 now in Atlantic, the guy with the paper bag over his head, and the takeaway was we're asset rich, we're liquidity poor. Half of America doesn't get access to $500 or something along those lines, and it really kind of forced us to look more broadly, and it's not just the however you want to peg the size of the young and underbanked that are profoundly economically insecure, unhealthy, and in dire straits. The proverbial, I live in LA, the proverbial kind of McMansion with the BMW outside, can be as cash strapped, as economically vulnerable, as close to, a disaster as someone who we would think of as, being in that situation. And then another important takeaway for us is that the old plumbing, the infrastructure of our financial services system hurts the poor more than anyone else. Think of ACH. That's kind of my favorite example, right? Like ACH runs on mainframes in batch, clears, over 24, 48 hours. We all have buffers and kind of, it's transparent to most of us. But, if you're living paycheck to paycheck and you're getting your check and you need access to it today, it's the ACH system's retarded double implication of that kind of, workings that have the check cashing industry exist at all. So real-time ACH would be of a profound impact to the young and underbanked. So we've been looking a lot actually in corners where many people aren't, so looking at the infrastructure of things. So these couple lessons have us looking beyond just the young and underbanked. So in some ways our mission has expanded, but in some ways it's deepened. So now instead of just looking at cost savings, right, how can we invest in a cheaper payday loan or in a cheaper, bill pay system? What can we do to invest in things that will increase people's income? And where does FinTech overlap with income creation? So we look at small business, we look at education finance, and the future of work as key areas where those things overlap. Second, of course, is absorbing shocks. It's really the shocks, the unintended consequences, the proverbial hole in the road, the broken car that puts us into these terrible spirals from which, if we don't have much of a safety net, we can't get out of. And so as a result of that, we've now, since, 4 or 5 years, been quite active in the InsurTech space to be smarter about absorbing shocks for those who can absorb them the least. And third is looking how FinTech applies in the biggest cost centers in everyday households. So FinTech is typically kind of imagined as technology applied to the financial services sector. We're really interested in FinTech outside of FinTech. So FinTech in housing, for example, the number one cost center for most households. FinTech in healthcare, FinTech in education, FinTech in transportation. And if you look at these industries, actually, it is FinTech where, speaking of commodification, where the greatest opportunity is for some of these companies to differentiate themselves, to build loyalty, to expand their businesses. So it's become a key area for Core's investment. So to give you a couple examples along those lines, and then I'll cede to conversation. First is another Stanford startup, actually, called Pando. This is a wild-eyed idea, and I hope this doesn't end up us being a venture backer of someone's PhD thesis here, but it's quite possible. This is a very bright-eyed team that's looking at basically disparate income. And so they're going after professions where the income divide is quite extreme. Sports is an easy example, but entertainment is another example. And they're also doing an experiment here at Stanford, which isn't quite demonstrate the purpose of why we invested, but it's still interesting. So take the NBA, right? Like there are a very small number of athletes who end up making $100 million, and the lion's share of professional baseball players will end up making somewhere in the $16,000 per year range and be professional athletes. So this is a pooling mechanism by which people at the onset of their career, with visibility into each other's propensity to succeed, and with kind of a clever actuarial support system, can band together in each other's success. Where if you cross over a certain floor, you are obligated to participate, or you commit to participate, some percent of your income. So the guy who ends up making $100 million ends up making 90, and the guys who end up making $16,000 end up making closer to 100. That kind of thing can be transformative to a small group of people's lives, and so it's a interesting, wild-eyed, rife with possible unintended consequences, but exactly the kind of bet that we like to make. And one I'm very excited to see how it plays out. So that's around income creation, and speaks to kind of the broader thing that we're, I think, really all trying to solve for, which is like a growing wealth inequity, a growing income inequity. Around absorbing shocks, we made an investment in a company called Hugo, and Hugo is basically offering auto insurance. Pretty straightforward. And it's one of these things that is oddly untackled. Weirdly, in California only there's 4 million people. Nationally, there's 30 million people who are uninsured, just plain car insurance. And our hypothesis is that is overwhelmingly not for willingness, but for ability reasons. Just like financial products, subprime insurance also stacks fees, high and upfront, making it a big hurdle for entry and making people want to get out as quickly as they possibly can, and retention low as a result of being kind of a shitty product. And so Hugo is effectively solving for a cash flow issue. And so they will charge daily. They've also reduced the scope of coverage to just be the minimum required, which most people bundle for fatter margins. And so they're basically going out to really help people reimagine what insurance can look like, and hopefully fewer people will find themselves with that broken car needing to go to the payday loan to kind of solve for a short-term cash need. Third example of looking at fintech outside of fintech is around housing. And we made a bet on a company called Padsplit in Atlanta, Georgia. And a year and change ago, I saw a guy named Brian Brooks, who was then the GC of Fannie Mae, give a talk about the next housing crisis. And his kind of takeaway was, the housing crisis 10 years ago was a financial one. The housing crisis we're about to enter now, and that is secular and going to be worse, is not a financial one, but a shortage of housing crisis, and specifically a shortage of entry-level housing crisis. And if you look at, like California and its ADU rules, and endless municipalities are trying to, figure out how do we make urban living more affordable. Padsplit is a private sector example of what's trying to help, what is fundamentally a public policy challenge. So Padsplit, effectively what they're doing is they're taking single-family homes that are 4-bedroom and making them into more bedrooms by taking out the living room and being able to occupy the basement, and so making them into 6 to 8-bedroom homes. And they're a glorified property management company that then will support for the landlord, the investor, who buys the home. They'll give them twice the income because there's more people in there, and they'll provide their tenants with a somewhere around 30-40% discount on what it would otherwise cost to live in an urban center, which gives them better employment opportunities by renting a home in a Padsplit facility, which has, and then they'll manage all of the supply side so that, as people move in and out, they'll take care of that. Disputes arrive, they'll take care of that. And they've been growing like a weed this year, and we're very excited about what they're doing. So those are a couple examples. My takeaway is basically, I just saw your deck this morning. I was so excited about your kind of 5-point framework, and I wish I had like a clever, point-by-point retort and where I agree and disagree. So rain check on that. But I really like the framework a lot. So I'll suffice to kind of end with a dumber, broader point, which is that I am genuinely excited about the possibility of technology to really move the dial here. And while I think, there's a lot of whitewashing and a lot of, fintech that is basically a ruse and repackaging and remarketing for the proverbial millennial and, the mobile native blah, 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 that really is not much different from anything we've seen before. I'm extremely excited about the power of technology to really change and move the dial for low, moderate income people and their upward economic opportunity. If you look at kind of the whole world of the shore banks and that universe, at the end of 50 years, they were serving about 1.5 million people in the United States. We're a tiny venture capital fund and not doing anything particularly, extraordinary. But at the end of 10 years, our portfolio companies are reaching 25 million consumers. 21 million of them are low, moderate income. And sure, we're touching them and affecting them in different ways than the community development world has. But the scale is undeniable. And I think, and this is 10 years in versus 50 years in. And so I think there's a lot of exciting work ahead of us from entrepreneurs, whether we invest in them or not, in creating economic opportunity. Thanks.